Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's Thursday, the 23rd of March, 2023. Back again, one of my favorite guests of all time, a man I've looked up to for decades, a true legend when it comes to the world of investing. Marc Chaikin is joining me today. We're going to talk about his power gauge, which has been around for years. His money flow indicator has been around since 1982, folks. I was in kindergarten at the time, but the guy's been around and he's proven himself time and time again in bull markets, bear markets, sideways markets. Marc's going to talk about some of the situations that's going on with the financial crisis. Marc is also going to dive into certain sectors that he sees are really strong right now, and also talk about a couple sectors that he's avoiding right now at the same time. We had Marc on late last year and he nailed it. So very excited to get him back on. So without further ado, here's Marc Chaikin. If you're holding out hope for a bull market, then please pay close attention. According to legendary investor Marc Chaikin, who Jim Cramer famously said he never bet against, you need to prepare for the next wave of volatility to hit U.S. stocks. Marc's prediction is based on an indicator that has only triggered a handful of times in the last 72 years, with a 100% success rate predicting where stocks will go next. Now, the man who's just spotted it is sounding the alarm. During Marc's 50-year career, he's worked alongside some of the biggest investors in history, including Paul Tudor Jones and Michael Steinhardt. In fact, Marc invented one of Wall Street's most popular indicators for picking stocks, still used by hedge funds, banks, and brokerage sites, and today found in every Bloomberg terminal on the planet. Now, Marc's inviting you to join him as he explains exactly what the next wave of volatility will look like and where it will send stocks in the coming months. He's even sharing one of his favorite ideas free for those who tune in. He says this idea could create bigger gains than anything he's used his power gauge system for until now, by turning the coming market volatility to your advantage. And you don't have to wait until March 28th to get started. For a sneak peek on Marc's big reveal, go to ChaikinEvent2023.com. That's ChaikinEvent2023.com. Here he is, the man, the myth, and definitely the legend. Marc Chaikin, thank you so much for coming back on and joining us here at Making Money.
Matt, it's good to be with you. I wish we were talking about my basketball skills instead of my stock market skills, but so be it. That ship has sailed.
The ship sailed, yeah, I know. I go out there now and I shoot around. I feel like I just got beat up. My back hurts. I mean, I'm laid up. I get massage, hit the cold bath and everything. Not the same as it used to be. But speaking of feeling beat up, Marc, the market in the last couple of weeks took a bit of a beating. I mean, it's held up actually pretty good, but it's taken a beating with this whole Silicon Valley Bank, Signature Bank, et cetera. What's your view of really what's going on here after seeing what's happened in the last couple of weeks?
Well, the Fed basically told us that they were going to raise rates until something broke, and they did. Something broke. Yeah. And it was a bank that was completely mismanaged, no risk controls, didn't even pay attention to the fact that interest rates were going up for a year. And, you could call it a one-off, except it turns out there are other banks in that situation. And I think the Fed stepped in and did what they had to do to make sure that the banking system in this country survived. And, there's going to be some knock-on effects of that and some lingering fears and concerns that's going to create a lot of volatility in the market. And we're seeing that pretty much day in and day out as one bank goes up and another goes down. But in general, I think that the bull market that I identified in mid-January, January 17th of 2023, is alive and will soon be well.
Yeah, I remember when we had you on last time, I think it was towards the end of 2022, if I'm not mistaken. And then you were talking about the bull market starting very soon, next month or two. And boy, you nailed it. I mean, you really, I think we had you on right before the low in October for the major indices. So you nailed that. I mean, so congrats. Doesn't surprise me, Marc, but congrats on that. Something you've been talking about recently is a term I came across that it's a rolling run up. Rolling crash also in there. Can you explain a little bit what you mean by that?
Well, everybody likes to talk in terms of bull markets or bear markets, and that's an easy convention, but it really masks what's going on under the surface in the market. So, for instance, history will say that this bear market of 2022 started on, I guess, January 4th of 2022. But in fact, that bear market started in February of 2021 when the ARK Innovation Fund peaked and all of Cathie Wood's stocks started to fall out of bed. So what you had there was innovative tech turning bearish and all these stocks trading down. So in essence, you had a bear market in innovative tech, and then it spilled over into other sectors and industry groups. So rather than a monolithic bear market that started in the S&P 500, you've really had a series of rolling crashes. And of the 22 sub-industry groups that we follow, where there are ETFs that are tradable, 21 of them have had rolling crash bear markets. And now, of course, we're seeing the financial sector and the various components in that sector rolling over as well. So that's sort of typical. It's happened 3 or 4 times since 2000, and it's something that the press doesn't report on because it's not as convenient as saying, okay, we're in a bear market or a bull market.
Yeah.
But coming out of that, you also have a series of rolling bull markets. So right now we've got a rolling bull market in tech, for instance. Why is that? Mm-hmm. Because A, they were very oversold, and B, the interest rate climate is going to get a little more favorable for tech, which tends to see valuations squeezed when interest rates are going up and valuations expand when interest rates are not.
So let me ask you this. First of all, you brought up a number there. You said 21 of the 22 subsectors. What is the one sector that didn't go into a rolling bear market?
Well, it was insurance, and sure enough, now it has. I'm not sure that the insurance sector is as affected by what happened at Silicon Valley Bank and the other banks that were commandeered by the Fed, but clearly interest rates coming down so sharply will have a negative effect on insurance company earnings because they clearly benefit during a period of rising interest rates. But with a very sharp pullback in the 2-year Treasury rate, almost unprecedented, the insurance industry and insurance stocks have taken a big hit here.
So is that something that your system will catch? They'll start seeing that kind of rolling over to help you avoid buying into insurance stocks here, avoid maybe getting caught in a value trap as they come down?
I'd like to say yes, categorically, but when something happens that quickly, nothing can really anticipate that. I mean, that was a sort of out of the blue event that blindsided the insurance industry. I mean, everything was great. We had about 10 or 12 insurance stocks that had bullish ratings in the Chaikin power gauge and were making new highs. And then suddenly this came along. Now, where the power gauge can help you is in some of the slow moving crashes that took place, let's say, with the banks that didn't just immediately unwind, but power gauge rating turned bearish on Signature Bank back in April of 2022. Okay. So you could have avoided that big, painful, slow grind down, which culminated in, the Fed basically closing the bank down. So that's where the power gauge is really helpful.
Yeah, I mean, and obviously, if Signature Bank peaked out at about $370 a share or something like that, halted at 70. Yep. So just think about that. And again, nobody's going to sell at the top or buy at the bottom. I don't expect that. But once that starts rolling over, just think about how much money that would save people getting out, not buying, but just getting out and taking the cash and moving on.
One of my favorite adages about the stock market from Herb Greenberg, who's part of the MarketWise umbrella, is it's the stocks you don't own that matter. If you can avoid those 2 or 3 losses that'll just decimate your portfolio every year, your results are immediately going to look better at the end of the year. And I think the
Yes.
power
Yeah.
gauge turned bearish at about 280 on signature. So you're right. Didn't
Wow.
catch the top, but you avoided an awful lot of pain.
So has this kind of financial turmoil, crisis, whatever you want to name, you want to put on it, how's it affecting your power gauge ratings in general? Has it taken a lot of sectors and turned it negative recently?
Not really. I mean, this is, I think what we're seeing in the markets has been confined primarily to the financial sector, but also to energy. And so energy has really done a pivot. We had some really bullish names in energy like Valero and PSX, which we liked heading into the year. In fact, Valero was one of my top 10 picks for 2023, and it was doing really well until this crisis hit. And you may wonder, well, what does Silicon Valley Bank have to do with the price of oil? And I'm not sure I know, but the market's musing on that now as we come up to an OPEC meeting. I think it's next week or in a couple of weeks. And OPEC's got to figure out what to do to shore up the price of oil, because it's certainly, been very weak here in the past 15 trading days. So I think other than those two sectors and the reemergence of tech, everything is pretty much as it was. Home builders, very strong. Construction, engineering, suppliers in that space, very strong. Retail, a mixed bag, but clearly energy is taking a big hit right now.
It's interesting, Mark, you mentioned construction engineering. I was up in the office a few weeks ago with some of my analysts and just going through a bunch of charts as we do. You know, we're chart nerds, just going through on a big screen. And I was like, what pattern do you guys recognize here? You know, what stocks are breaking out? Construction and engineering. These engineering firms were, and this is a couple weeks ago, but boy, oh boy, they look so healthy in the charts. It was unbelievable. I'm like, that tells you something. You know, it's a visual that you can't fight that. You can't fight the tape. And maybe it's infrastructure coming up. Maybe it's the fact that we're still building a ton of houses. I don't know, but that it surprised me. But I'll be honest with you when I saw that. But that's where the power gauge that you have comes in handy, because I could just went there and they could tell me, Matt, quit wasting your time. Go to happy hour. You could go have happy hour, and Mark's gauge will tell me what to do. I don't have to look through 1,000 charts.
Well, even better news is that it turned bullish on these stocks back in October and November of 2022. So you've had new all-time highs in a number of stocks that we've actually put into our portfolios. Companies that make something as mundane as electrical conduit, and where does that become a growth industry? Well, in California, where they're mandating that I think that every new house have an EV charger.
Yeah.
And so you've got to bring in some heavy duty wiring for that. And this company called ATKR provides that conduit. And that's just one example. There's companies in the air conditioning business and construction companies in general. A company like Builders First Source, which we really love, BLDR, have been making new highs, pulled back nicely here, and they supply the home builders, the DIY market, and also, general construction. So, but this has been a trend that's been in place since October, November. It's not a Johnny-come-lately move.
Yeah. But what I love about those two names you just mentioned, which people who subscribe to your, the power gauge will get these names, is they're not your run of the mill. Nothing against the media. I was in the media for 10 years, but it always bothers me. It's like, okay, give me your top pick. A guy's making 7 figures a year to come up with stock ideas, and it's Apple. Wow, where'd you come up with that one? It's like the stocks that you're finding here, the average person's not going to find ATKR. They're not going to find Builders First. They might, but they probably don't know it because they're not looking at thousands of charts in all these companies, which is it's what I love about what you do. You're finding ideas that you're not finding anywhere else. I'm not saying that you won't be bullish on Apple at some point.
There's a larger message in what you just said, Matt, which is these are small and mid-cap companies. And once this financial sort of crisis passes, and it will pass, everything looks dire in the trenches, but once this passes, I think that the market's going to go refocus on small and mid-cap companies again. I like some of the mega companies like NVIDIA and Advanced Micro, but I think that it's small and mid cap stocks that are, have been neglected for the last 10 years of the bull market from '08 that are going to really experience a resurgence. And that was happening until this sort of smoke and dust from the last 2 weeks.
Do you think the Fed potentially pausing sooner rather than later? Rates obviously came down with the financial situation. Will be a big boost to these small mid-cap names that sometimes are perceived as riskier and more interest rate sensitive. Do you think that's going to help boost them, throughout the rest of this year?
I don't know. Actually, that may be a fallacy in the marketplace. The small and mid-cap stocks were actually doing quite well as the Fed was raising rates and tightening, and in fact led the market from the October lows that you referenced earlier in the broadcast. So there may be a misconception in the market. Now, obviously, if you're a small cap stock that doesn't make any money, and I think in the Russell 3000 there are over 800 companies that don't make any money, and that's typically in the small cap space. There you've got a problem when rates are going up, because they've either got to service their debt at higher interest rates, or they have no ability to borrow. But if you're making money as a small and mid-cap stock, I think you do well in a rising interest rate environment.
That's interesting, because that's not the narrative you typically hear. That's not the narrative you typically hear. And I'm glad you brought up like the Russell. I'm looking at IWM, the Russell 2000 ETF, and it kind of bottomed in June, bottomed again, kind of double bottomed in October, pulled back again in December. We're now back down to the December lows. So as the actual index of those 2,000 stocks haven't done real well and actually underperformed the large caps since October. That being said, as you mentioned, with the power gauge that you have, you're picking those individual stocks. And that's very difficult for somebody to do on their own. So having the system that you have, I mean, this is something that I think all individual investors should have access to, because trying to do it themselves, going through 2,000 companies, Russell 2000, they have jobs. People have jobs, or they're retiring or enjoying retirement. Let you do it for them, right? I mean, that's what you built over decades.
And if you're in France, you're retiring at 62 and you've got a lot of time on your hands, or soon to be 64.
I would say, I'm not too happy about that.
No. Well, one of the problems with the IWM is, guess what? A big constituency is its small cap financial stocks, and is a lot of small cap energy stocks. So that's now a drag. Put up a symbol called CSML. This is something we probably don't talk about, because there are some issues about not recommending something that has your name on it where you have an economic incentive. But we created a small cap index for NASDAQ, which is a tradable ETF called the Chaikin Small Cap Index. And what we did, sort of apropos of what you just said, is we overlaid the Chaikin power gauge on NASDAQ's version of the Russell 2000. And we basically culled out the bearish stocks. And what you're left with is an index called the NASDAQ Chaikin Small Cap Index. And that's the best of the best, in essence. Those are the stocks. Yeah. It's a more concentrated portfolio. I think it's got a couple of hundred names in it. Rebalance once a year. Those are the stocks that started the rebalance period on April 1st with bullish power gauge rating. So it gives you an edge, and I'm not recommending this ETF because it can't, but it just shows you what you can do with the power gauge. And in the last 3 years, it's significantly outperformed the IWM.
It's funny you say that, because I just pulled up a 3-year comparison of IWM versus CSML, and this is, maybe not updated here, but greatly outperformed it by from 107% gain to 76% gain. I mean, that's in a 3-year time frame. That's a very, very big difference.
PDG, as I like to say. But I should, in the spirit of full disclosure, in the period when the mega cap stocks and tech in general was outperforming, the CSML did underperform IWM. But the last 3 years have been a perfect time. Yeah. And again, this is not a recommendation.
Of course. Yeah. We're not, nothing on the show that I ever say or anybody bring on is never a recommendation. We're sharing ideas and education. You must do your own due diligence and obviously go out there and make that decision. based off that. But I'm glad you brought it up because, again, what this proves, Mark, is that the system works. The power gauge works. That's what I'm saying. That
Yeah,
it's going to find
absolutely.
the sectors that should be going into, because, you know, I hate this term, but there's always a bull market somewhere, right? I think Jim Cramer says that every 3 days. So like people keep saying it like that, but there's truth to it, that there is a bull market somewhere. You talked about insurance companies recently getting hit, energy underperforming. That being said, big tech has been doing great recently. Engineering, we talked about, has been doing great recently. But you have to know when it's time to get out, and more importantly, when it's time to get in. So when I'm looking at your power gauge, I'm always looking for something to turn green, to turn bullish, to tell me to buy, because obviously I'm a long-term bull, as you know. So I'm looking for that. Do you have any indication, or like just your own thought process of some areas? And you don't have to share everything because you have a big presentation coming up, obviously. But anything that you want to share that you've seen that you can, or that is close to potentially becoming a buy here?
Well, I think there are some buys that have triggered over the last 2 months as the bull market has started to unfold, or what I believe is a bull market has started to unfold. So you have some really interesting strength in the airlines, for instance, which have bullish ratings for the first time in a long time. You have strength in the home builders, which flies in the face of all the headlines. And that's what the power gauge is good at. It's good at looking at the data and not the headlines. And again, construction and engineering, very, very strong. Even in the energy space, with the the majors and the refiners showing bearish ratings now, like Oxy recently, you have the energy equipment stocks with bullish ratings. So you've got to really look under the surface, especially since we're coming out of a bear market that took no prisoners through October. And again, you mentioned the October low, and I think that's really critical, because everybody who's hand-wringing on CNBC these days about how we're in a bear market rally and so forth, we're so far from that October low, and I hope that's true when this airs and when our event airs on March 28th, that it's hard to say we're not in an upswing, with so many stocks making new all-time highs as of 10 days ago. And that's just not characteristic of a bear market. You got to find these names as they're turning. NVIDIA turned bullish in our model, I think, a week and a half or 2 weeks ago, and then suddenly you have a big bank recommending it today. So we tend to be ahead of the banks, ahead of the analysts, and that's a good thing.
That's a great thing, yeah. And you're right. A lot of people are calling this a bear market rally, and I'm a technician at heart. I love looking at charts, and just looking at the chart of the S&P 500. There was a clear downtrend that began really end of 2021, and lower highs, lower lows, and that downtrend line was broken on my chart, and right around the time you talked about January 14th, right around mid-January, is broken. And what I like, Mark, since then is the S&P's hung above that. That obviously does a role reversal. That's now support for me. And since October, we've made 2 new highs in this new uptrend and 2 higher lows. So if you actually look at the charts, it's showing that we're in the midst of what I believe is a new uptrend that's starting.
Yeah, and a hand grenade has exploded in the market here in the last week, and yet we're holding pretty strong. This morning, the market was rallying really nicely, and then the Michigan sentiment survey came out, and it showed that inflation expectations were up. I mean, the computers that drive the market now are just programmed to look for small, sort of dog whistle phrases that can move the market. But it wouldn't surprise me to see us end up on the week on a pretty positive note.
Yeah, and I've been saying that in the face of everything that's going on, the market to me has held up pretty damn well. If you're in a bear market, like they say, and we have news like this, I expect the Dow to be down 1,000 points. I expect the market to get absolutely demolished, and we're not. And that strength to me tells me something. You and I have been doing this a long time, looking at charts, listening to talking heads, getting our own opinion, and I feel like maybe it's my gut, but the fact that it's holding up really well in the face of the second largest bank collapse ever is pretty damn bullish, in my opinion.
I agree. And I think you identified my favorite technical pattern because it doesn't require any, fancy indicators, which is higher highs and higher lows, you're in an uptrend. Lower highs and lower lows, you're in a downtrend. And I think that's really critical. And most people tend to overcomplicate this, as you know. And I've created indicators, but they're basically simple indicators that are logical, like Chaikin money flow. And I don't think you need to be a rocket scientist to figure out which side of the boat you want to be on and where the wind is blowing. And I think that's really important. And most people overcomplicate it. But to another point that I think is relevant here, a lot of the technicians who didn't turn bullish in January were looking for panic selling. And that's true. Panic has typically happened at or before a major bottom in a bear market. And because we had this series of rolling bear markets in different industry groups, I was sort of content to believe that we could end the bear market without a wave of panic selling. Well, guess what we just had? We had panic selling. Yeah. And it happened to be concentrated in one very important sector in the market. But if you are looking for sort of what we used to call puking out, where people just throw out everything in their portfolio, probably not because they want to, but because they have to through margin calls or leverage bets, we just got it. Yeah. Now, whether there are a couple of other shoes to drop remains to be seen. But, if you're constantly looking for shadows in the market, you're going to miss out on the big upswings when they happen.
Yeah, and the fact that you made a great point there, kind of these rolling bear markets we've had, it didn't all happen at once, and that's why we didn't have that capitulation. Everybody threw in a towel.
There's the word. Sorry, it escaped me.
Yeah. So, but again, we just had one of the most important sectors in the market, the financials, get absolutely crushed, panic selling, and at the same time, the overall market, the S&P 500, NASDAQ, they're holding above those new uptrend lines. I mean, that says something. That you can't debate that. And I love that you talked about the trend line, because I used to give these speeches all the time and help people learn charts, and have somebody come on before me, and I'm like, what the hell is this? It looks like my niece drew a bunch of crayons on the thing. I mean, there's 75 lines up and down. I'm like, this doesn't tell me anything. It's very simple. Are you in an uptrend or a downtrend? And if you're buying an uptrend, there's like really good odds you're going to make money. You're buying a downtrend, you're probably going to lose money. It's that simple at the end of the day.
It's that simple. And if you just throw in Chaikin money flow, which has been around since 1982, so got a long track record, and see if that's confirming the uptrend or starting to diverge, especially in something like the SPY, it's gold. But in individual stocks, even better. You get a stock with a pattern of higher highs and higher lows that pulls back because it's gotten caught up in stock market volatility like we've seen over the past week, and it gets oversold on a short-term basis, chances are Chaikin money flow has stayed in the green. And one of the best short-term entry points you can ever have is a stock that's been in an uptrend, pulls back because of general market conditions, and the sellers are not there. They're buying the weakness. Rather, the buyers are still there. They're buying the weakness. Whoever's been accumulating AMD, and in this case, it's probably Dan Loeb, or Builder's First Source, is viewing that pullback as an opportunity. And this is sort of Warren Buffett in action in the market. You got to be fearful when other people are greedy, and greedy when other people are fearful. And whether you're a short-term trader or a longer-term tech investor like you, they're just great entry points, great points to add to an existing position or initiate a position. But Chaikin money flow does an unbelievable job of doing that, and it has for 40 years.
Yeah, and that's something that if somebody has an idea, obviously you share ideas through the newsletter, so people don't have to go out. But if they want to go out on their own, they can use the power gauge and put it in there, and they could look, okay, maybe I thought I had a great idea. The power gauge says, hey, listen, Matt, you are wrong. Wait till it turns green, and I'll be patient and I'll wait. So that's very important too, to kind of, people can use this both ways. They can use it on their own stuff, their DIY. They can use it on the stuff that you and your team recommend, which is great, because I'm just, if anything, when I managed money for 17 years, I always said, I'm not some crazy stock picker. I'm not out there. I'm not Warren Buffett, but I'm going to protect you from yourself because I'm going to make sure you don't make bad decisions and panic sell the financials on the day when they get crushed. And instead look to buy some of that when the money flow turns. So this is what you do, Mark, is just amazing because you help people make money, but you also are helping to protect them against themselves at the same time.
Well, and that is clearly the biggest problem with trying to be a market timer, or if you're a DIY investor who's managing your own money, you get caught up in the headlines. And, people say, well, did you see this on CNBC? And I said, no. They said, well, who was it? Kyle Bass was on. Well, I don't have the sound on. If I have CNBC on, which I don't every day, I don't have the sound on. It's so distracting. So anybody who's getting their information from CNBC, whether it's from Cramer or any of the talking heads, is totally distracted and is likely to do what you just said, which is to panic at the wrong time.
Well, before I let you go, Mark, I know you've been a busy man doing the rounds here, getting ready for the big webinar on the 28th of March. Any closing thoughts that you have before we let you go?
I think use history as your guide. We're in a election cycle, the 4-year election cycle in the year when the market usually has its best performance, the pre-presidential election year, and view this volatility as something that you can take advantage of instead of something that you're afraid of. So I really do think it's time to load up on some stocks where the industry tailwinds are in your favor, like some of the industry groups we talked about, home builders, construction and engineering, and take advantage of this. And by the end of the year, you may just really say thank you to anybody who encouraged you not to panic.
Well, I'm saying thank you ahead of time, okay? I'm sure I'll see you before that, but I'm saying thank you.
I hope so.
No, honestly, thank you so much for coming on the show. You're one of my heroes, so having you on all the time, I love it. I really appreciate it.
Hero worship is dangerous, but I always enjoy talking to you. Smart man. And
all right.
Always a pleasure.
Good luck on the webinar, and we'll have you back on soon. Thanks so much, Mark.
Yeah, I'll look forward to it, Matt. Thank you.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.